the Fed signals it's almost ready to taper, causing yields to break higher. Equities rally, led by energy and financials, whilst tech stocks suffer due to the higher rates. And commodity markets such as nat gas and coal go exponential to the upside, helping oil to break out to new recent highs. All this and more in this week's Macro Insight. Okay, welcome back to Macro Insight, everyone. Today is the 28th of September, and let's take a look at markets. So, last week, obviously the market started on the back foot with the Evergrande concerns at the start of last week. But, as we kind of thought we would see, we saw more injections of liquidity from the Chinese authorities. And the kind of lack of spillover into the investment grade market, even though it did pop a little bit, it hasn't got out of control in the domestic market, and then international credit markets really didn't seem phased at all, right? So the market was able to bounce, and that the market basically giving China the benefit of the doubt there, that even if Evergrande was to go, the banking sector and the rest of the Chinese economy will be supported to some extent. And whereas the property, the property sector in China will take a bit of a hit from the deleveraging, the market right now is assuming that they're not just going to let the entire economy collapse and it just be a complete and utter shitstorm, basically, right? So that's what the market seems to think for now. Evergrande did miss its dollar bond coupon on Thursday, but they've entered into like a 30-day grace period to avoid default. They've got another one coming up. So we'll see how this thing's going to get managed, right? But this thing's not going away, and I think it's going to, it certainly is going to hit the tape, over the next few weeks still. So it's going to be kind of lingering there, but at the moment the market's still kind of scratching its head as to whether there's going to be any major contagion out of this, right? And for now, it's giving the benefit of the doubt that it's not. That may well turn out to be wrong, but let's kind of keep an eye on the tape and see what comes. The other major event last week was obviously the well-anticipated Fed meeting. And, we got a strong signal from the Fed that they're very close to starting tapering later in the year. They're looking for a certain amount of recovery in the jobs market, and Powell pretty much said that's as good as done. So, on the back of that, we saw hawkish reaction in the rates market, but the equity market, which was already a little bit nervous from what happened with Evergrande and volatility was already elevated, we saw a rally driven by cyclicals, and the VIX that was at in the high 20s collapsed back down as we had been flagging, right? So I share the my charts. So obviously, people had been bidding volatility. The skew had been very, very steep, and the market had a pullback. So the VIX had got as high as, very close to 30, in fact. But I had been saying, all last week that these VIX spikes don't tend to last much longer than a week to 10 days max. And I was of the similar belief that, the risk reward there was to be selling that spike. And it didn't take long. It took 1, 2, 3, 4 days, and we were back down to 17 on the VIX, basically, right? So had been selling into that spike. Obviously, subscribers will know. Got some. I was selling all the way up into that spike. Got some away at 26. Covered that on Friday in the low 20s. Now, something I had also done to protect that VIX short was to do very short-dated risk reversals, because I was of the belief that we were unlikely to pop above 4,500 in a hurry. And even if we did, those upside calls were going to come down a lot in terms of vol terms. So I thought that short on the upside was a decent way to protect. And that allowed me to get some premium for a super short dated put in case Powell said something that made the market roll over, right? So that was the way I traded that. So I kind of used a little bit of premium for what I was going to make if Vols collapsed, to have a risk reversal protecting that short vol position. And I was able to, make a little bit out of that, but not just be blindly short a load of risk. That's the thing. When you sell VIX and you sell outright volatility, even though it looks like a good entry point, you've got to be very aware that these VIX spikes and these vol spikes can turn into events that are pretty catastrophic, right? So just blindly selling without any protection in the book can be pretty dangerous. And that's not really what I would recommend when you do those type of trades. Yeah. Okay. What else? So VIX, as you can see, collapsed back down to the more normal range, closer to 20 again. Like I said, there's not a lot of point in being short maximum amount of VIX at these levels now. So I did cover some of those. I am still a little bit short because I do think we could, settle down and drift back towards those 15, 16 area over time, but certainly covering a large part of my short there because the edge has kind of gone away a little bit, right? And give myself some bullets that if we do get another spike back towards maybe 23, 24, then I may have bullets to resell into that. So that's kind of how I'm looking at that. Post FOMC, let's look at what happened in rates, right? So we had seen rates have been kind of coiling here. So they were pretty range bound, coiling here, and then we got the final break, right? So initially the move was more flattening move. So you had the short end of the rates popping more than the back. And that we've been seeing that a lot, right? When you see a hawkish reaction in the rates market to something that the central bank does, normally you see a flattening of the curve because they're basically saying, okay, we're going to pull rate hikes forward, and that's going to be bad for the economy longer term. So we don't need to take the longer end up as much. That lasted for about a day and then completely reversed, right? So we saw 10-year breakthrough, this sort of top of this downtrend around 140, and it's kind of gone straight 10 bips higher to 150, right? So something in the rates market is basically now saying, okay, maybe it's not a policy error, and maybe the reason why rates have to go higher is because we're going to see an improving economy, right? So that's kind of how I read the rates reaction at the moment, right? So actually more positive on the growth outlook as well, and saying, okay, some kind of taper is justified. They're going to manage it, but the reason they're tapering is not because they're scared of inflation necessarily, but actually we are going to see an uptick in growth post-COVID and that type of thing, okay? And you can see here where you had that move, you had that flattening move in, say, 30s, 5s, that has recovered a little bit, basically. It hasn't recovered that much, but it has recovered a bit from that knee-jerk move down, yeah? 2s, 10s, you see here, 2s, 10s actually steeper, right? So, not this type of price action we've been seeing in the yield curve of late when we see a hawkish type move, right? When we see rates actually go up, yeah? Okay, so what is the playbook when we see, if it looks like rates are now sort of broken out of that downtrend and maybe headed higher? Not sure how quickly, but looks a lot of people thinking that's what's happening. So then we've got to look back at the old Russell versus NASDAQ trade, right? And the value versus growth type trades. So then we need to look at this. So here you've got the 10-year, so popping, as you can see. And, this sort of Russell versus NASDAQ was kind of tracking it to some extent, right? So that started underperforming in May, as we saw, the 10-year is rolling over. That's been in the doldrums, but it's been forming a bit of a base through July, August, September. And now, as we've got this pop in yields, the question now is, does the Russell basically come back to life relative to the NASDAQ, right? And we're already starting to see a bit of underperformance in the NASDAQ. Russell had a strong day yesterday. We had a bunch of inflows into the Russell ETF at the end of last week, suggesting that a few people are going to start chasing that trade, basically, right? So that's really the thing people are focused on. Things like small caps, mid caps, to play that sort of cyclical upturn. And that's also going to be reflected in the sectors, right? So if we look at the sector breakdown last week, where are we? So you see here, So that's from sort of this time last week. We've had a massive outperformance, 12% from XLE, energy sector, obviously on the back of very strong performance in oil. But then you've got metals and mining, you've got XLF. So those are your big sort of cyclical winners, basically, right? Which we often tend to see when, so, you know, financials are helped by that pop in yields and that particularly the pop in the yield curve. And then obviously, you know, the cyclical part of metals and mining and the energy stocks, basically, right? Who are the laggards? Well, it's those defensives, right? It's healthcare, utilities, real estate, you know, all those sort of more rate sensitive sectors. And tech's, you know, tech's not doing amazingly either, only up 1.6 relative to those others. Okay. And we could see if yields continue to go higher, tech may well end up going into sort of the more negative territory, basically. Okay, so that's kind of what's been happening. If we look at the broader market, so obviously this rotation is now starting to kick in, people getting a little bit more optimistic about growth and where we're going to see growth numbers or high frequency growth numbers over the next couple of months. What's been going on in the S&P? So the S&P, yeah, obviously had that breakdown last week. Key level in the sand, one of the big levels for me was 42.85. Managed to not break that, which was good. And we didn't stay below 43.50 for very long either, right? So we kind of recovered, sort of mean reverted back to the average, and now, you know, having another little test on the downside, but nothing too sinister by the looks of it, okay? You know, spot gamma levels, obviously, we've been tracking. There's a big JP Morgan trade that gets rolled on a quarterly basis. That's kind of the one that they've been flagging recently. So the big strike to be aware of is the 44.30 strike, yeah, which is expiring, you know, on month end, right? So this Thursday. Let me show you this chart. Here we go. So this is kind of showing us the levels in terms of where the big strikes are. So you've got 44.50, you've got 44.30, but 44.30 we know for sure is a short position from the buy side, which is making the dealers long that strike. Okay. So the question is whether do they roll it? Do they just let it expire? We'll see. Normally their MO tends to be to roll it. So if they're going to roll it, they've got like a couple of days to roll it, right? But right now, the street is long that strike, which will be providing some sort of gamma positioning long, which should be providing some sort of support to the market, which in theory is going to make it relatively harder for the market to break down significantly before that gamma has gone away. Okay, so you might find a bit of support coming from that large strike at 44.30. Now, if we get below, if we go significantly below, if we go, say, below 43.80, there's no real gamma on that strike anymore, right? That goes away, and then the market is free to do its thing and move lower potentially, right? So we've got this kind of pivot point here, somewhere in around 4,400, 43.80, where, you know, the market below that, there's nothing supporting us. But, you know, in the above 4,400, we've got this strike probably giving some gravity to the market, basically. And that also applies on the upside, right? If we rally too much away from that 43.30, we're going to struggle to get too far away from it probably before the expiry day. So, you know, 44.60, 44.70, we get as far as there, we're probably going to start to get pulled back, basically, right? So that's the price action to kind of expect there. Yeah. Okay. What else? So we talked about the sector breakdown. Now, the other thing that people are now sort of turning their attention towards is the debt ceiling. And, you know, in previous debt ceiling kind of episodes, you know, the market doesn't get too spooked. So a lot of market professionals are kind of thinking this is not really anything to be overly concerned about, right? And I kind of tend to agree, but don't be surprised if you get a load of you know, media coverage on the topic. Okay. Now there was this nice graphic out by Goldman's. Debt limit will bind in October. So basically what they're saying here is we're gonna, you know, I think the deadline is like the end of the month. Okay. Government's going to go into technical, you know, shutdown or whatever it is, but they've got money basically, right? They've got money to tide them over, and it's happened before, right? So they've got cash for extraordinary measures, and they'll be running that cash down as they're sorting out the political theater that is to raise the debt ceiling, basically, right? So the idea being from this Goldman's thing is that, well, they're going to have a pot of cash to play with to kind of keep things ticking over, but maybe by sort of towards the end of October, if it still isn't resolved, that's when you're going to start maybe having a problem, right? So I would say, you're not going to get much of a market reaction for another week or two. But if the debt ceiling issue is still not resolved by end of October, then there might be a bit more of an issue there, and markets might start to pay attention to it, basically, right? So that's the thing to be aware of. But like I say, it's timing-wise, probably for the next week or two, not a major concern, I would say. Okay. Right. And then what are the things to kind of look out for this week? We've got Fed speakers out in force today. So let's see what they say. If we continue to get more hawkishness, the fact that yields are rising, maybe that is because, that is the expectation. We've got Eurozone confidence surveys out on Wednesday, China PMIs. We've got the US infrastructure bill being voted on Thursday, and the PCE inflation data out on Friday in the US, right? So those are your main data points that are coming. In FX, the dollar's grind its way back up to the top of the range, right? So question is, can it finally break out? I mean, we've tested this third time. Is it going to be third time lucky on the dollar? Obviously, the move in yields is kind of the driver here. But, it's not got massive momentum on this move. You've still got the momentum indicator not making a new high. I'm not convinced that we're going to break, to be honest. I think we might fail again at this 94 level. So remains to be seen. I'm not playing for a breakout in the dollar, especially, to be honest. That's my view. Obviously, on the flip side of that, if we did get a break in the dollar, it would probably trigger a fair bit of risk asset nervousness and turbulence. So watch out for that. You might get some pullbacks in some commodities and things like that, more violent pullbacks, because commodities are going a bit crazy at the moment. So watch out for that. But yeah, my base case wouldn't be that we're going to get a breakout here, to be honest. So Euro, flip side of that chart, obviously big support zone between 116, 116.70, 80, where we are now. So we're entering that zone. Again, we're not doing it with any sort of velocity. I suspect we're going to find some support off this zone, as we have done many times. Yeah. And then the pound, 136 was the level in the pound that's held, and it's actually having a go at breaking it to the downside here, basically, right? So pound, maybe, if the pound can actually break this level, where's the next major level of support? It could probably extend as far as sort of 134, basically, before it finds any meaningful support, I would say. Yeah. So watch out there. Pound looking probably a little bit more bearish than the euro right now. Yeah. Okay. And then commodities. So commodities, obviously, the big thing in commodities is what's going on in natural gas, right? So haven't really traded it myself. I've dabbled in natural gas a few times in my life, not many, but after it went a bit parabolic, I've kind of stayed away from it, and well, it continues to go parabolic, right? So there's this massive gas squeeze going on in Europe, and that's now feeding through to the rest of the globe. And what that's doing is it's basically creating sort of exponential price moves in all sorts of other things, basically, right? So let me share this chart here. So it's up like 26% in 4 days, natural gas, right? Which is just unbelievable. And it's creating this massive squeeze for coal, for carbon emissions, German power, Dutch gas. These are the charts. These are all the exponential charts, basically. Okay. So that the worry is now that if we get a cold winter, then we're really screwed, basically, right? And you're going to get power shortages left, right, and center, basically, right? So that's the worry, and hard to really see what's going to pull this back, right? So I don't know what's going to happen with this, but I haven't traded it, but there's just this massive squeeze going on, and it's filtering through to a lot of things. Now it's even filtering through to the oil price, right? So we're seeing oil break higher as well. Bring up the oil chart. So WTI, you know, having it's not quite as, it's not parabolic like what's going on in gas, but see here, we've established a bit of a channel here. We've gone to the top of that channel. That happens to be the July highs as well in WTI, right? So I have been long this, as subscribers will know. You know, I bought that consolidation in oil. I added to it when we broke 70s. That's been a decent run. I did take some off yesterday as we were, you know, starting to look a bit stretched now in the short term. And we were, you know, reaching this kind of July high level as well. I still think this could go a hell of a lot higher, right? I think we could, if we broke out of here, then we've got a probably target of about 85 over the next month or two. But we could also have a pullback. So I've just kind of lightened up a little bit on my exposure to give me bullets to maybe buy a pullback. If we do start to have a pullback and consolidate, you know, back towards this sort of 73 area, that gives me bullets to sort of reload again. But that's all I'm doing. I'm just trading around a core long position that I like. I have trailed stops. You know, if we break 72, then maybe we get some sort of more move to the downside, and we get to pick it up in the high 60s again, basically, right? But for now, still long, but just trimming the position, basically. That's my thoughts on oil. Now, gold is just horrible, right? Like the gold chart has just been in trouble for a while. But, you know, the latest catalyst for the gold weakness has been the move in real yields. Yeah, so bring up this chart here. So what have we seen in gold? Well, recently, the move in real yields has been, you know, a decent move, right? It was about around minus 110. It's popped now to around minus 85 bips, basically, right? So a decent pop in real yields, usually pretty bearish for gold. And, you know, as such, we have seen gold start to break down again. You know, if this kind of mini reflation trade is back on, i.e. we do see a bounce in growth data, we do see some leadership out of cyclicals as we started to see in the stock market, then, you know, it probably means real yields have got a bit more room to trade up towards this minus 0.7 area, which seems to be a bit of a target level in real yields, in tips yields. And then that will, you know, that will probably lead gold lower, and we may even kind of test this key zone down here of 1680 that was met earlier in the year, right? So no reason to jump in, I don't think, and really buy gold down here on this weakness. Still feels like that weakness may have some room to run. And then, you know, if we do get to later in the year where we've had this sort of mini reflation bounce, then chances are economic activity does start to fizzle out and it's not a long-term sustainable trend higher in growth, then you might want to pick up some gold at discounted prices, basically, right? But I wouldn't be jumping in and buying gold with both hands right now. Yeah, I have picked up some silver before, earlier on the dip. I still have it, but if we break down below 22, where I kind of started to get, you know, I was thinking of, you know, buying more, and probably more in the camp of just getting rid of it and waiting, to be honest, right? Silver did offer a bit more value. But if gold's going to remain weak, I don't really see silver doing a whole lot, to be honest. I think gold needs to at least be sort of rallying a little bit to get some real upside out of silver. Basically, those are my thoughts. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.